Good evening. I'm Avery Lyford, Chairman of the Churchill Club. Welcome to our VC panel this evening. We've got a rock star panel. Some panelists still getting here. Complicated traffic this evening. The panelists that are here right now, Gretsch from Sigma, Bill Maris from Google Ventures, Kate Mitchell from Scale Venture Partners, Ray Rothrock from Venrock, and we're looking forward to Aydin Senkut from Felicis Ventures and Tim Chang from Mayfield. And then, of course, we've got our moderator, Steve Bengston from Pricewaterhouse. Thank you all for being here. Our thanks also go to our wonderful sponsors, Microsoft, especially Dana Lewin and Doug Free, TechCU, especially Barbara Cam, and Womble Carlisle, especially Mike Giancarella. Thank you for your community leadership and your making this program possible. It is great to see a sold-out audience. It's a packed house. You can feel the pulse of Silicon Valley, and we've got people here from literally the entire world. People from New York, Norway, the UK. New York counts as a different country when you're in California. Remember that you, the audience, are the reason for having this program. So if there's a question that isn't covered in the panel and you think it's important, there will be a Q&A session at the end. Call for Mike, and you'll have a chance to get your question on the table. Our next program is next Tuesday. We're joining with Oxford University's Say Business School and the Oxford Union and the Santa Clara University to do the first annual Oxford Union Silicon Valley debate. It should be a great evening of provocation and persuasion. The motion on the table is that the problems of tomorrow are too big for the entrepreneurs of today. So that should lead to a lively discussion. This event will be huge for Silicon Valley, and look forward to you all joining us for a great program. By the way, all students, teachers, interns, and starving entrepreneurs are welcome to attend free of charge. Please contact our office, info@churchillclub.org, to get that set up. We will also shortly be posting 2 programs for July. The first is a CIO agenda on July 24th with the CIOs of Walmart, PG&E, Google, and Juniper, and a CMO agenda, Chief Marketing Officer agenda, with the Chief Marketing Officers of Intuit, Google, and PayPal. Both those should be great programs. If you're tweeting, please use the hashtag Churchill Club, and you'll also find other Twitter codes in your program. Finally, it is my pleasure to introduce the moderator, Steve Bengston. Steve is Managing Director of Emerging Technologies at PwC. He is also the past chair of the Churchill Club Board of Directors, where I have the pleasure to be working with them. Aside from the world of business and technology, he has been a long-time resident of Silicon Valley and is well qualified to lead this great discussion. It's all yours, Steve.
Thanks, Avery. Everyone here in the back, mic's working okay? So the format for tonight, I'm going to give a very quick summary of the venture industry. Then each of the panelists can talk as little or as much as they want about themes they see going on. And then I'll start firing away questions till we get questions from the audience, which we'll take early and often. The only thing we ask is you wait for the mic to appear so that everyone can hear it, not only the audience, but for the taping that we're doing that will go worldwide. So quickly, the venture capital industry has been around about 50 years, 50 years. It started in Boston. So Boston had 100% market share for the first few years. Then Silicon Valley got the bug and slowly grabbed supremacy of the market from Boston. So about 30 years ago, Silicon Valley took over the #1 slot, which it has not relinquished in 30 years. In fact, its lead has increased. You think of all the cities and all the countries that are trying to be the Silicon fill in the blank, and yet Silicon Valley's market share today is greater than any time in history, which is not intuitive. Fast forward to today, Silicon Valley gets about 40% of the venture money in the U.S., and Boston, New York, and Southern California are essentially tied for second at 10% each. So the big four, coming from the PwC, we only talk about the big four. They get about 70% of the total is just in those 4 regions in the market. Put another context, if you look at VC worldwide, a third of venture capital in the world goes into California, a third goes into the rest of the U.S., and a third goes into the rest of the world. So heavy, heavy concentration of venture capital right here in California. If you look at industries, the top 4 industries for the past year or two in order have been software, so it's almost always number 1, then biotech, clean tech, and medical devices. One thing that's unusual about that list is, which we'll talk on this panel, is that software things are robust. I think we're going to mainly hear good news, but biotech, clean tech, medical devices, big problems in those sectors. Yet they're still huge. In fact, they're the number 2, 3, and 4 sectors in the market. If you look at dollars invested in the industry, it's been an amazingly volatile industry for the last 20 years because it was not volatile the first 30 years. If you look at the 80s, venture capitalists in the aggregate in the U.S. invested about $3 billion a year, all of them. I think our panelists tonight combined probably invest $3 billion a year. So the scale of the industry has really changed, but it was very stable, almost $3 billion every year in the 80s. The 90s, again, started at $3 billion a year, but by the end of the decade, it was $50 billion. And then in the 2000s, it started at $100 billion, the crazy times, but by the end of the decade, it had crashed to $20 billion, and it's been in the 20 to 25 billion range for about the past 5 or 6 years. So anybody's guess where it will be in 10 years, but you can see it's been quite volatile. Returns were very steady the first 40 or so years. They averaged about 20% overall in the industry. It was a very, very healthy sector, which is why it kept getting more and more money. The last 10 years have been a disaster. The average IRR for the industry has been negative every year for the last 10 years, and it's been negative for the entire 10 years. And this is a sector that its job is to return more than it takes. VC fundraising is now brutal for everyone that's not on our stage. In fact, it looks like we got 2 panelists that are still trying to raise money.
Yeah.
Exactly.
That's good.
Exits have also changed dramatically. The first 40 years in the industry, IPOs were the dominant form of exit. There were many, many more IPOs than M&A. It's hard to believe now because in the last 10 years, that's completely switched, where M&A is roughly 90% of the exits, and IPOs are not so common. Big picture, the VC industry has been great for America. Jobs, which are very timely, it's probably produced more jobs than any single industry out there. Most of the high-tech companies in the world, or at least in the U.S., have been venture-backed. And our venture capital industry is the envy of the world. In fact, virtually every country in the world is trying to recreate it. And I think I meet their ambassadors whenever they come into Silicon Valley, because there's lots of contingents that come here who want to recreate Silicon Valley. So that's a quick overview, and then I want to just run down our panelists and have them kind of opine about themes they're seeing that might be helpful. Starting with Greg Gretsch at Sigma.
So, very good overview.
Okay, he's coming back.
A lot of interesting statistics. I think one of the things that happened in the venture business, probably 20-ish years ago, and Steve can tell us when, is it went from being a purely boutique business to being an asset class. And as soon as it became an asset class, and it's this thing that all these different groups said, I have to have a little piece of this in my portfolio, and that's when the amount of dollars going into venture just mushroomed. And when in virtually any asset class, when dollars rush in, returns rush out, and that's certainly what happened in venture. I think the big thing that we're seeing right now in the business today, there was talk before Facebook's IPO about a bubble. I think the talk of a bubble has gone away, but what we are definitely seeing, and it's been going on for the last couple of years, there's always been a spread in Silicon Valley between sort of the average valuation and the hot companies. Hot companies have always gotten a premium valuation. What's happened in the last 2+ years is the spread has just grown to gargantuan proportions. So everyone hears about the billion-dollar private companies and billion-dollar-plus valuations. That's a very small select group of companies, and a lot of it is chasing the brand. Venture firms, no one on this panel, but other venture firms want to go and put the logo of the company they know is going to be the hot company on their website and say we were involved in. A year ago it was we were involved in Groupon, we were involved in Zynga, we were involved in Facebook. That's not looking like it panned out too well, but that's been driving these private company valuations, and you see companies that are frankly very good companies but are raising money at valuations that really do create problems for them down the road, as it did for those 3 companies.
Thanks, Greg. Next up is Ray Rothrock with Venrock, who I think is probably the longest tenured venture firm as well as partner on the panel tonight. So that's why he's wearing a tie.
That's right.
Yeah, really well.
And it's got clouds on it, so that's my future thinking. So thanks, Steve. I've been around since '88 in venture capital, and before that I participated in the Silicon Valley in startup companies, Sun Microsystem, and then 2 deals before that. So I've kind of been on both sides of the table. But everything Greg said is true about the asset class. In fact, I wish that never had have happened because I don't think this is the kind of class it is. But what's real important and what drove a lot of the negative results, other than too much capital, is that capital got tied up for too long. When I got into the business, the holding period was 3 or 4 years, and most of the exits were IPOs if they were a successful company. Otherwise, the lemons ripen early, and so you move on. Unfortunately, when the capital consumption increased and the holding period got long, that early startup capital couldn't get out to go do it again. And that just really prolonged everything. So now what we're living in 2012 and probably next for the is LP pressure like we've never had before. We need our money back, or we need some cash flows, we need something. And I was really hoping that the last couple of quarters were a sign that we'd see IPOs. We've actually had 4 in the last 6 months, which back in the day we would have 7 or 8 or 9 a year. And so I was thinking, well, maybe it's coming back. But as Kate and I were talking earlier, the VIX index is off the charts on both sides, and that seems to be driving things. Nobody has any confidence anymore. You've got the global macro. So my big thing, having a little bit of gray hair, is that we got to get this holding period down, because the money that goes in the A round has got to come out quicker. And if that doesn't happen, if we're stuck in this long holding period, I think we're going to go into malaise, and I think that's really bad for the industry. I don't know what you're looking for exactly, Steve. I mean, hot areas, obviously cloud. Anything that lowers cost at the end of the day is good.
And do you see anything in the works that's going to lower the holding period?
Well, the Jobs Act's trying to do a lot of that, and Kate can talk expertly about that since she was a primary author of it. And we saw a lot of that. I mean, very quickly there was data that just people suddenly were headed out. And I mean, one of my deals got out quickly as a result of this. So that's got to happen. I think some of these big corporations have got to, this is probably not a good thing to say. I see our sponsors up there, but they and Daniel's sitting over here on the right. But they have massive balance sheets, and they have the choice to wait, and they can wait out some of these deals. So I think if they got a little bit more proactive strategically, they might engage more. There was a day when Microsoft, Cisco, Sun, Oracle, they were a little bit more aggressive, and I think that would help us all if they see a need.
Thanks, Ray. Next up is Kate Mitchell with Scale Ventures, and we're honored to have the current and past president of the NVCA
there we are.
right here on our stage.
Thanks, Kate. You did a great job.
I talked you into it. Pass that off. You want me to kick it off? Okay.
You're up, yeah.
Kate Mitchell, Managing Director, Scale Venture Partners, located in Silicon Valley, invest across the U.S. To put context into conversations we'll probably have throughout this hour, we invest usually early, very often 40% of the deals Series A, but right after the technology is done, usually when a company is beginning to figure out how to go to market. Can I sell it? Can I sell it repeatedly? And can I sell it profitably? Hence the name Scale, because that's what they're trying to do. And before it really kind of hits the logo shopping days. A couple things that you brought up, Steve, is that I think are interesting to talk about. Connecting the dots between the amount of money invested. We have Tim Chang, who's going to give us
Welcome, Tim.
little drum roll.
Close the
Give
fund.
you a sense. We're talking. You guys were out fundraising.
Yeah. Some people just really like dessert.
Exactly. But you talked about $20 billion being invested roughly annual, or kind of at a stable state with that. That is and has been consistently over the amount of money raised by our industry by somewhere between 5 to 8 billion a year. The music is going to stop. And it's never been that inverted for a long time. And I don't have the most recent, they're just about to be published, but roughly 20 billion invested a year and 12 to 15 raised. That's a gap that has to, eventually the numbers, will work. And I think it does get to these issues about return and other things. So I think that is a very extraordinary situation. I think when you look at this, and by the way, the 10-year numbers are pretty poor. The 1-year numbers are actually quite good. I mean, when you look at 09, particularly 10 and 11, the 3 to 1 year numbers are actually starting to turn up. And what was fascinating for those of us in the industry, and again, many of you are entrepreneurs, and the dollars we raise, ultimately, I mean, we're really the conduit between, I think of my mother who's in a nursing pension, union pension, the need for my mother to have returns, and the best entrepreneurs out there. That's really our job. And if there are too much of us, there are too many entrepreneurs founded, it really, too many companies founded, it hurts the industry. Getting that right-sized is really critical. But looking at those numbers going up, you kind of, in some ways, you don't want to have this dollars, like you say, Greg, start flushing, back in. And when you look at what happened, we had this peak of dollars raised in the industry, and everybody knows about the bubble. All of us in the industry really thought the dollars coming into venture would crash immediately after the bubble. It didn't. It actually started crashing in the 08-09 when the liquidity issues came in. And again, the sources of capital, be they foundations, endowments, pensions, that ultimately make their way into you.
And also when the 10-year returns were
The 10-year
really
returns,
close to turning negative.
The 10-year returns turned negative, so they couldn't bring it to their committee, number one. And number two, all of a sudden, we had an endowment we were talking to that went from doing due diligence on us in a fundraise to borrowing capital from the operating budget of the university to make capital calls to other commitments they'd made previously. Ouch. That's not good. So I think that's really when things kind of turned upside down. So it is an interesting time in the industry. And we can talk at some point about IPOs, because I do think IPOs, both help, we need to get, the companies that went public, Zynga, LinkedIn, certainly Facebook, don't even fit in small cap investors' portfolios.
Right.
They're too big. They're multi-billion-dollar companies by the time they go public. I think Bill Gurley was on Bloomberg earlier this week. I followed him a day later, but said, Facebook waited too long to go public. You can't join the NFL as a 45-year-old, which is in essence what they were trying to do. I love that line. We don't want 16-year-olds either, which is what we had at the bubble. We probably want, pick a number. You guys probably know about football, 21-year-olds or something. But in any event, I think that finding that right balance, we don't want 16-year-olds, we don't want 45-year-olds, getting it back to its right level. And frankly, it makes people like poor Daniel and others have to compete more if the alternative is to go public. Right. And the other thing that I think we hope that came out of the Jobs Act was that entrepreneurs would aim higher. It's less about doing a series of small companies that I sell off as not even a product but maybe a feature, that I really start thinking about creating the really kind of big iconic companies whose logos you see on the back of the room, who are sponsors of events like this. Because that, and interestingly enough, spending so much time over the last years with entrepreneurs who frankly were the most active around the Jobs Act, more so than VCs who can make some great money out of M&A from an IRR point of view, and their LPs are asking for a quick return of capital. It was really entrepreneurs, which was a thrill for me, and a great opportunity to meet a lot of people across the industry of all shapes and sizes. And a lot of the aha back was, if I can go public, I actually might design my company differently from the very beginning. I might actually aim higher going forward, which actually was some of the most interesting conversations for all of us. So that's kind of my 2 cents. We'll have a chance to dive into all these issues, I'm sure.
Thanks, Kate. Next up is Bill Maris with Google Ventures.
So I'm probably a bit of a contrarian, just to touch on, we're not even 5 minutes in and the Facebook IPO came up already. So I'll bite and say,
go.
I feel like that was a pretty successful IPO. It was efficiently priced. They raised
a lot of money.
$12 billion or something like that.
Absolutely.
Look at the Google IPO and how much money was left on the table.
Yeah.
And so it didn't double immediately out of the gate. I just think public perception of what makes a successful IPO is different from what I, as a founder or CEO of a company, would think makes a successful IPO. Of course, you don't want the price to decline, but all things considered, it could have been a lot worse. And then to touch on something that Greg said earlier, it's not, if you study the data, it's not surprising to me that venture over the last 10 years has had a negative return. It is an asset class now. If you look at even mutual funds, there's no persistence of performance among the average mutual fund doesn't beat its index. So you don't really want, as an LP, you don't want to invest in the average venture fund. The difference in the venture business is, and we spend a lot of time studying this data, that there is persistence of performance among top funds. And so they are doing something different or attracting a different kind of deal or entrepreneur. And I actually think it's healthy that there's a lot of capital available to entrepreneurs, because while venture capitalists may not like it, as founders, it's a lot friendlier a place to raise money. And having tried to raise money in Silicon Valley in the past, I've had that experience. And frankly, I feel like, present company accepted, there was a real lack of competition that some VCs benefited from over the course of time, sort of pre-90s, that benefited some VCs, and then people looked at that and said, well, we can get into this business because it's a tough business, but there are more difficult jobs than the ones we're doing. So I'm not surprised that capital is available, and there are more VC funds now than there used to be.
Thanks, Bill. And next up is Tim Chang with Mayfield.
What's the question, by the way?
There you go. That's a way to start.
Do you have any themes that you want to just throw out there, as little or as much as you want to talk about?
Okay, sure. Interesting times right now, I'd say. A few factors that we've been wrestling with: the rise of the so-called super angels, sort of the seed bubble that's been going on, exemplified by the so-called party rounds, where people take a coffee meeting and suddenly this super angel's in, then another one, and it's all a convertible note and it's uncapped. And this goes hand in glove with the rise of Y Combinator, the lean startup, the rise of sort of the mentality of it's you versus the suits. You don't need the VCs. Screw them, F them, F the VCs. And there's a lot of that kind of stuff going on. Everybody's about capital efficiency and lean, which I think is really wonderful on the consumer side. Not sure, it fits. I don't think I'd try to build a lean semiconductor company, but, for certain areas it does fit. I do think there's a lot of hubris going on in that area, and it is starting to slow down a little bit. Incubators sell the story that you all deserve funding, everyone should be a CEO. And I worry it attracts a lot of bridge and tunnel entrepreneurs, because somewhere in the last 2 years, starting a company became cool. And I don't know, call me old-fashioned, but I've always thought that there's sort of two types of entrepreneurs I've usually seen. Folks who do something because they love it, they don't care if it makes money. It was just their passion. They would have built it anyway, and then it just accidentally explodes, and then money chases them. That's cool. The second example are people who cut their teeth and came up through a particular domain, became experts in it, really earned their stripes, and then saw a big market need they wanted to attack, having worked in the industry. That's sort of the classic, I think, path. But these days I see a whole lot of wannabe entrepreneurs, and you get a lot of manufactured businesses. And this is the ones where seed money is flowing easily. And you get a lot of iterative businesses, which I call X for Y companies. We're Pinterest for cats. We're Groupon for blind people. It's just sort of like...
I totally get that.
It's like these sort of like feature things that aren't even meant to be companies. They're often, actually, I think, acqui-hires in disguise. But, it's great because it allows everyone to try entrepreneurship, which I think is wonderful. But I think it could be very wasteful in some ways. Here's my point of view on that, is that, look, instead of like 500 companies training the next thousands of entrepreneurs, what if we have like 50,000 crappy companies? And then people expend a lot of energy and time, and there's a lot of opportunity cost lost there in sort of these small iterative companies. Makes hiring really expensive. The labor pool is crazy right now. And I used to think it was a cost issue. It's not even that. It's an availability issue. Those top 10% engineers that you want, it's not that you can't afford them. You can't even get them, because they all want to be founders of their own, or they're stuck somewhere else doing other things where they themselves are angel investors now. So it's not even about affordability of them. It's just that they're not even on the table. And the level of entitlement there is pretty fascinating. And I need to come up with an index for this, but if there was average price for mediocre developer in the Valley, that'd be a great barometer for sort of the, I think, inflation of labor cost. And that's something that we see these days, like new grads saying, I want $175,000 plus 25K signing bonus. And it's pretty brutal out there, and all of our companies are starving for talent because everybody is a CEO. And so
it's
I
brutal
think
unless you're a mediocre developer, then it's not so brutal.
Oh, it's great.
So,
Yeah, exactly.
I don't know. I have a slightly different take, which is, I mean, in 1997, let's say, there were, 50 million people on the internet. So in order to reach scale, let's say to reach 5 million people, you'd have to get 10% of the market. Now with 3 billion, 4 billion people online on mobile devices and otherwise, to reach 50 million people might only take a mediocre developer. And so it seems sensible to me that there would be lots of people trying to start companies, because you can make a decent living by having a fairly small or narrow product.
Yeah.
And that doesn't strike me as bad. I think that it's probably not the kind of companies that you're looking to fund because you're looking for $1 billion.
I was going to say, it depends on the scale and the scope you're trying to go after. I think, hey, if I was just graduating, I'd probably go for Y Combinator too. Why not? It's sort of a free option. It makes me think, at least in the consumer side, it's kind of like startup Darwinism, or you'll have every possible permutation of types of companies, and some will thrive and some won't. Many of them won't, and there's sort of a cost of that, but you'll see some really interesting things pop out of that as well.
Yeah,
For VCs, it makes it tough.
hey, we have a new one. And to finish that thought, I mean, I think it's horses for courses, because, I agree with Bill. I think that, if the focus of some of that early stage capital and the angel, we'll see what happens with crowdsourcing. We'll talk about that separately. But that whole, if the idea is that, pick a number, 98% of them, you might put in, again, you're going to have a high failure rate, but that the goal is, hey, I put in collectively 50,000 and sell it for 500. That's a great return.
Mm-hmm.
Probably not a venture return. Probably not for us. We don't want to look at those. Now, a couple of them really might be the kinds of companies that we are interested in. And I actually have to say, particularly as you get out of Silicon Valley, the other benefit of that whole sort of angel network is you're building people who are more willing to take risks. Because I think that's one of the challenges when you get out of Silicon Valley, is people that aren't, or in disciplines where it's been always much easier to take the safe route and not really kind of lean into it. And some of it I see from an entrepreneurial point of view is a bit of a training. If somebody thinks they can be CEO, knock themselves out, they'll be running back to a different company if they really flame out early, but we'll have learned a lot in the process that might make them better for our portfolio company. So I can see that it does fit part of the ecosystem, the idea that somebody can take 50K and turn it into 500, that's great. A few of those will blossom into bigger things, but we're also growing other folks who can think more entrepreneurially, even who decide to go work for the logos on the back. As a country, I think we've got to go away from safety to innovation, so I don't think it's all bad. But I hear what you say. I love your X for Y, the Pinterest for it. We're getting a lot of that these days. I'll add that to the mix.
Well, Aydin's been working on his presentation for a few minutes, so
It's going to have a slideshow.
welcome, Aydin Senkut from Felicis. And Aydin, if you want to add to the conversation, we're just chatting about just themes that you're seeing, or things that either impress you or really bug you about what's going on in either the venture world or the entrepreneurial world these days.
Sure. I guess, where we stand, so 6-year history as an angel investor, then super angel. Now we grow up, we call ourselves a boutique fund, boutique venture fund. Couple things, I think, there were things that really excite me and things that kind of, I think, are a little bit disconcerting. That's why we're kind of slightly shifting direction. One is that there are a lot of great engineers in Silicon Valley, but they're all focused on same incremental problems, at least 90% of them. That's kind of the big challenge that I see. When people ask, hey, is there a crunch, is there a bubble in valuation? I'm like, if you're working on something that is a really critical problem, as human beings, we tend to underestimate future growth. I think that's where the big opportunity is, right? So when we see it, we're like, oh, it's obvious. You look at Facebook, it's a $100 billion company. But when Facebook was valued at $1 billion, people were not saying, oh, my God, they couldn't picture it to be a $100 billion company. So the way that we're thinking about it is we have found some companies like Rovio that are growing to incredible levels. For instance, we got excited about Instagram at $1 billion, but Rovio is a company that grew revenues 11x, has 67% net profit margin. This is public results. So we're trying to figure out what other areas are there are potential to find these incredible companies. So connected devices at home, and I'm sorry if some of this is repetitive, but so we're trying to shift our attention more from these seed deals that get crowded, that you don't have fundamentals, that you're worried if it's undervalued, overvalued, and thinking more about what are the areas that are ripe for technical solution but is not being solved. Like a good example is there was a company that I can't talk about yet, but they're applying the same Silicon Valley engineering ethos to genomic data and doing something really interesting. And the example that we like to use is Amazon e-commerce company or a software company. They're applying software excellence to a lot of areas of e-commerce. I feel like they're masquerading in an e-commerce company, but they're really a software company. Mm-hmm. And I think there are 5, 6 other disciplines like that right now looks like it's hard science, but it's going to start becoming more and more like software, which means that Moore's law will apply and a lot of great companies will get created. That's when sometimes when the question comes up is like, what's the next Facebook or whatever? Or same thing, like the next Google was not a Google and the next Facebook will not be a Facebook. Yes. So we're trying to figure out what are the exciting areas that we should be paying a lot of attention to.
So we touched on the IPO market recently. Let's just examine that a little more. Just a couple a handful of questions, but anything's fair game. Before the Facebook IPO, there were a lot of articles similar to before the Google IPO that it was was it going to spur a whole slurry of IPOs. Google did not do that, but it didn't crash the market. Facebook not only didn't do that, but it actually crashed the market. So why the difference? And is the IPO market largely closed now, or does it seem more open than many people think? Do you care, NASDAQ versus NYSE? We see a lot of people going public on both. Are foreign exchanges taken over? China in the last couple of years has done more tech IPOs than anywhere in the world. And is 70 kind of the new normal? In the 90s, we were doing 150 to 200 tech IPOs. The last handful of years, we've done 50 to 70. So should that be our expectation, or is the Jobs Act going to fix everything?
I can start with an easy quote. Last week, I was at a conference, and the banker should remain nameless. But the first comment...
You got a lot of nameless stuff.
There was a lot of nameless people. His first comment to me was, even a week after the Facebook IPO happened, there were trades that were unconfirmed, that were really large size.
Yeah.
So, data point. The second thing is, I think Google was really special because when we did the IPO, we actually had really solid business results. And when you look at the IPO market and you look at the companies whose stock is kind of tanking, I think people are waking up and saying, look, we don't really care about a hot company or not. If it doesn't have the business metrics, if it doesn't have the financial performance, we're just not going to give it a multiple that they think they can dream, but it has to be earned. And so
I would say, what would have been an outcome for the Facebook IPO that people would have been happy with? I mean, had it gone up by 3x or 5x or 2x, people would say, oh, there's this crazy bubble. And had it, it went down, so they say, well, it was a failure. And I just don't think any of those things are true. It's sort of like we're in between this period of, boom and bust, and it always feels like this in between those periods where it's sort of a lot of unknowns, and you have an election coming up and a crisis in Europe. There's always something going on, but for me, like the question of is the IPO market open or closed is just sort of a red herring. It just doesn't. It's not something that we spend a lot of time thinking about or talking about because, I mean, an IPO is just another. It's a fundraising round. It's something different, but it's also really it's a way for a company to raise money, and they did that effectively, and the company will ultimately be worth the discounted value of its future cash flow.
The IPO market is fundamentally different from what it was back in any time prior to the consent decree. Really, Starbucks. Everyone blames Starbucks for it, and Starbucks is an issue, and Starbucks is one of the things that makes it more expensive to be a public company today. But there are two other issues that are really technical issues. The Elliott Spitzer consent decree that sort of squashed research coverage and cut the connection between research and selling. The issue there is there's no one to market a small company's IPO, and if there's no one to market it, there isn't going to be anyone buying it. And the second thing that happened, and this happened sometime in the 2000s, was decimalization. I don't know if everyone here remembers when
97.
96.
Yeah, so actually all this started happening back then. And you see it on charts very clearly.
So decimalization, it's when things traded for something in an eighth. Well, when you have decimalization, the market makers can make money on the spread between the bid and the ask. When you go away from fractions to decimals, the bid and the ask might be 2 cents apart. There's no money to be made there. So,
except in huge volumes.
Except in huge volumes, which means the big names, all the guys along the back of the thing, you can make money trading those, not a lot, but you can still shave a little bit. But on a $30 million tech IPO or a $100 million tech IPO, no one's buying it because they don't know about it, and they can't. The market makers can't make money trading it. So until those things are fixed, which are fundamental, market changes.
I think there's something more. I just think there's something more. I think there's something more going on, which to me is partially has to do with the media, where at some point the stock market became a sport, became like the NBA. Like everyone has a favorite stock, and you track it every day, and you want to trade it and know kind of what's going on, and it's not a sport. And I don't know that. I mean, my personal view is I don't know that most individuals should own public equities, individual companies, because it's a very dangerous thing to tie up a big piece of your net worth in an individual company. And I think the media has played a role in that, in the bubble and the bust, and always trying to define kind of what time we're in right now.
So bringing some of that together, I think there is yet another dimension that's not talked about much. It's the emotional dimension. It's the ability to buy the cult figure. Mm-hmm. So if you had bought Microsoft, the day it went public and held today, you would have 900 times your money. If you bought Google, you'd have 10 times your money. If you bought Facebook, what's it got to go to, $1 trillion to get 10 times your money?
Right.
What are the chances of that? So there's a there's a total economic rationale, and I agree, Bill, it was very successful. If I were a director, they got the maximum money, they topped it out, all that's good. But there's an issue with tech that goes to the cult and the following and the emotional compound that I think, at least I lived through that in the 80s and the 90s, where you weren't just buying a stock, you were buying Steve Jobs or Bill Gates. You were buying these visionaries, and you could buy their products and own both, the company and the product. I don't know how you can do that
and
in
it's
Facebook.
hard because what's happened is that brand has become a proxy, though, for performance, and people have stopped focusing on performance, and they just focus on the brand. And I think that's been compounded by the lack of supply of IPOs. There's so few that people get so excited, and if it's something that people use as consumers, there's kind of this, they move away, and guess what? Things find the right level after quarter of announcement. Sure. They find the right level based on performance. I do think, and I agree with you, Greg, entirely, that decimalization is kind of one of the things that hasn't. This idea, and not all of us in this room were buying and selling shares, in those days, but when companies like Schwab and E-Trade and all that, the thesis around decimalization, all that was to make the idea of access to the market more democratic, easier, less control. What's happened is it has really shifted and it's important for you as entrepreneurs to understand this. The result of all this is not only that research is oriented around those big high volume companies, the trading has been now really dominated by high frequency trading, algorithmic trading. It's gotten to the point that over the last 5 years, that ratio of trades and the exchanges has gone from 25%. I mean, it was nascent, a decade ago, 25% in the last 5 years, up to 75 to 85% in the really high volatility times. That's interesting to think about. Then the point of an IP of what's happening in the exchanges isn't to invest in growth; it's to invest in volatility. That's what high frequency trading is about, and that's where the money's being made, and why people are leaving banks to go work for hedge funds and all these math PhDs. So there's some fundamental things that Greg was laying out that I think have really shifted it and make it less friendly and very difficult for companies then to be heard. I do think it is possible, and I think that some of the changes that are taking place are going to make a difference. I actually think, Steve, that it's not Facebook's IPO that has meant we've had a drought. It added to the volatility, but Greece and the debt ceiling came right on the heels of that, and then bad economic reports. And when you talk to investors, that's really one of the factors, because if LinkedIn, Splunk, or Demandware were going public, they'd get out. There are a lot of investors that are talking to companies with good fundamentals that are probably going to, if there's when a window opens in the next couple quarters, continue to come out. So I do think we're not going to completely solve it, to Greg's point. We're going to make it marginally better with the Jobs Act, and I think and you see this happening. And by the way, for entrepreneurs, this idea of being able to file your draft S1 confidentially is one of the really big. You have less, not just cost to go public, economic cost. You have less reputational cost to go public. It'll allow you to position yourself better. But I do think all of us, venture capitalists, and you all as entrepreneurs, thinking about going public, it is still a less hospitable environment. You therefore have to really drive getting out, just as you do in your private rounds. You spend a lot of time figuring out who's my angel investor. At some point, do I want to do crowdfunding? What do I think about venture capital? How do I want to do that? You spend a lot of time due diligencing. Yes, you should. We're partners in the business. You should be doing the same thing in your public round. It's not like magic. And you should be driving giving your future over to any investment bank who has a transaction-based business. You should be using them as a facilitator for you to be meeting your next round of investors, and you want to get as many long-term holders who are savvy, just like all the way through from angels all the way through, equally the same on the public side. So I think there's a lot of education for a lot of us going forward. There haven't been a lot of IPOs. There will be more, driving it more, thinking about who you want to court over time as long-term public investors, with the kind of role you take, I think will make a big difference. But I do think directionally.
Maybe we should send all those algorithmic trading robots to the road shows instead of the people.
Yeah, wouldn't that be easier?
So
Yeah.
three unique data points. Number one, I used to get as an angel, I used to get calls from VCs in terms of, hey, what are your greatest companies we want to invest? If it's a data point, in the last 3 weeks, I got calls from 3 different hedge funds saying, we want to look at your companies. If they don't want to go IPO, we might want to be interested in them, kind of having mezzanine rounds. The second thing that's really interesting is that, at least in the enterprise sector, there is 2x multiple right now to public markets. Private companies are paying 2x the multiple of the IPOs. The point that I'm trying to make is we're kind of get excited about IPOs, but there's other stuff out there. And the other point that I'm trying to make is there's a lot of capital. So let's not kind of lose sleep over what's happening in the IPO market. It would be great, but there is other stuff. And then the third thing is, I've been really surprised and shocked by how many companies are building great businesses and growing fast, and actually are thinking about IPOs where I would think that they would be thinking more about M&A. There is $100 billion cash out there that is controlled, probably plus or minus 20, 30 great companies, but I'm surprised by founders thinking about the IPO market, looking at the hiccups and saying, you know what, it's not a big deal. I'm just going to shoot for 2x of the requirements. Like if it's a minimum requirement of 100 million revenues and 10% profitability, I'm going to at least overshoot that by 2x. And there are actually some brave founders that are building great businesses that are not afraid of the IPO market, and they don't seem to be deterred by what's happening currently.
Let's switch to value add in the venture world itself. You know, when the venture industry was young, virtually all the VCs were former operating people that had grown big companies, and they were very helpful. When the industry exploded, we kind of got a wave of MBAs, lawyers, bankers.
But you know, by the way, in the beginning, though, they were also generalists. You had people that were doing technology investing right alongside biotech investing.
Right, but they had been operators in some industry. You know,
Well, and some people, Ben Rosen was a banker.
Do I not get to
Yeah,
finish
I
the
was gonna
sentence
say-
anymore?
Yeah, I
Because
was thinking the
jumping
same
right
thing.
in.
Yeah, I'm not sure.
And then we got this wave of staff people that came right out of biz school, law school, accounting, but had never run a business. And that probably was part of the problem. It seems like we're going back to kind of the future. We're getting more operating people. And just talk a little bit about how you see the model changing within venture, the type of people, and because you've even got a number of funds that are touting all the stuff they do besides writing checks.
To me, that's marketing. Most of us have been doing recruiting help, business development, all of these things from the start. I don't think we just beat our chests or did as many press releases about it. The other thing I would say, many of us have been in the industry for a decade or more. I think we did that ourselves as opposed to outsourcing to junior MBAs or whatnot, and hiring armies of biz dev recruiting people and say, here you go, you do it. Okay, there's effectiveness in that, but I think it's a bet that by staffing up and institutionalizing it and marketing it, it'll be a more effective story than I guess partners who've built those Rolodexes and do it themselves and probably do it for their portfolios but might not market it as aggressively. When I first got in the industry 12 years ago, I was doing these biz dev days personally and out there humping all the conferences, building up carrier networks painfully, one by one, relationships with OEMs, chip vendors, baseband vendors, all those sorts of folks. It took 7 years to build that network. And it's something that I remember doing and still do for every portfolio company.
So we got one vote that it's all marketing hype. Any different opinion?
Well, and another point on that, 12 years ago, 99, 2000, when all these firms were looking at themselves as institutions, you had a lot of firms going out and hiring the recruiting partner, the marketing partner, the this partner, the that partner. We're seeing a little bit of that coming back again because it worked so well last time. They thought they'd do it again this time.
Barksdale.
Well, I just have a different. I think context is everything. I can look at this from both sides of the coin. If you look at arguably the two most successful venture capitalists of all time, Mike Moritz and John Doerr, neither of them were operators of businesses. Mike was a journalist, and John was at Intel in sales. And so that's one side. The other side is we had a very unique opportunity to build a new venture fund at Google Ventures from scratch. And so what we asked ourselves was, in a world where money is a commodity, how would we differentiate the product that we would offer so as to be able to make a pitch that we would accept as former founders and entrepreneurs, that it's not a zero-sum game. It's not sort of, well, you should take our money instead of John Doerr's. If John wants to invest in your company, that's something you should really think about. But if we offer the exact same product that someone else is offering, we're sort of not on a level playing field. So when we built out our team, we said, well, there are certain problems we face as entrepreneurs, and if there were a firm out there that could help us solve some of those problems, really help, not just say sort of the magic words that we're going to help you and not actually do it, but help hire technical talent, recruit engineers, help you with your storytelling, your marketing, your engineering and sort of platform work, that would be valuable and a differentiating factor. And so we've built out a very broad team, and we have over 50 people on our our team now, and we found it to be very additive. We've invested with virtually every firm at this point on Sand Hill Road, and never really elbowed someone out of a deal. It's with over 100 companies in the portfolio now. What we found, and the data is what I always turn to, founders telling us it's been great to have the Rolodex of so-and-so. You know, this great experienced venture capitalist who's been at it for 40 years, which we can't replicate because we haven't been at it for 40 years. In addition to the recruiting machine that you guys have built, i.e. Google Ventures, that they couldn't build and they don't aspire to build. And so we've found that kind of help to be really important to our founders. So I think for us it goes beyond just marketing. There certainly are people that say we'll do those things and then don't, but I think proof is in the pudding.
I also think, we've all narrowed. I mean, my point early on about generalist to narrowing, while there are some that are trying to replicate I have all those shops available, for you all as entrepreneurs, you want a complement of skills around your board, and be it outside investor, outside independent board members, or your advisory committees, and your investors. And a lot of us have really narrowed down over time on things that, you'll have different stage, folks that do really early stage and can help you think about, because they've experienced it, the earliest stage. Somebody like ourselves, we really focus on how do you really think about sales metric, how are you listening to the dials, what kind of dials might you want to set in your business so that you actually are listening to it, modestly investing, doing some A/B testing around what works as a go-to-market strategy, and then get really aggressive if you think you really have a winner, and really invest more aggressively at that point. We think through that piece particularly, you get some very later stage investors who really help you think about positioning yourself for different kinds of exits and have a lot more business development, potentially IPO, all those kinds of skills. So you actually want to be thinking about, one size fits all. Everybody saying they do everything is probably silly. You're going to find that as you're talking to investors, be they angels or institutional funds, we have a different shtick that differentiates ourselves. That is both something we sell to our limited partners because it's the prism around which we look at deals and how we find deals, but it also it translates directly to typically what we can do for you.
Let me just add one piece of data, which is if you look at the data, the single fact that the more highly syndicated a deal is, the more highly correlated it is with the positive exit. Like that's a true statement based on data.
Different skills.
And we've carried that over to our firm, saying the more diverse the skill set that we have internally, the more capable we'll be to help an entrepreneur, not to the exclusion of the other model, which is the VC as Swiss Army knife, where you have, I can help you, I know the right people to call, I can get you an outside board member. That's all true, and that works. We just have this model, which is slightly different, and if you look at the data, the more syndicated a deal is. That's why we welcome co-investors, because the more people involved, the better.
It'd be interesting to check that data and see if it's selection bias.
So I think
because when you have a successful company,
I can
by the time you get
100%
there,
assure you
it's not
has been
selection
checked for
bias.
selection bias.
You guys have looked at
The
it.
only element that I would add to it from our point is funny. We're basically realizing that the buckets like early stage or, hey, we do deals only this valuation, none of those buckets really matter. I mean, we doubled our exits from 2010 to now, so we have 28 exits. And the one thing that we've seen is half of those were expensive deals. We also seen that scarcity really helps. I mean, there are some firms that have built great reputations, have great teams, employ 50 people. We only have a team of 3 people, and on paper, none of us look like we would be great venture capitalists. And what we've seen is that we use scarcity to our advantage to be more creative and resourceful. And so the 2 things that work for us, number one, it's not just simple things like Rolodexes and other stuff and staff, but to our entrepreneurs, 10% of the number of deals that we do outbound represent 40% of our NAV. And by that I mean there are companies out there that are already really successful, they don't need money, that choose to work with us because our approach is different. We basically do our homework and say we only invest around focus areas, and we know those areas really well because we know that we can make better decisions and we can add more value, and because of that we get to work with great companies, the knowledge of which then we transcend, right? I think it kind of went beyond operational or banker or whatever. What we're seeing is that it doesn't really matter if I tell someone I was an early Googler, I was the first product manager. That's 12-year-old knowledge. It's completely obsolete. What really matters is the companies we're working that are breaking new ground and trying to be able to translate those great skills to others. And then also the other thing is it's never the quantity of help, the quantity of resources, but when can you do when you're called, and also being able to get out of the way when you're not needed. I think the founders today, especially the real successful one, when we look at it, the real companies, the founders that are doing really well don't need a lot of help. But when they do need help and when they make that call, you have to be there. And they all talk to each other, and brand is built that way. So we are essentially only going to be able to build a long-term franchise by having founders that really like us. So we really still believe that this is a boutique business and build one relationship at a time. And it also involves like, hey, you talk to a founder like, well, we want to do only a common thing. By the way, we want to do the deal. We don't want a board member. We require meetings in 3 different countries. And it's mind-blowing to us that there are billion-dollar funds that they would not bother to get on a plane, leave Silicon Valley to go to a remote city in Canada to do a great deal. But we do. We're a tiny little fund. We only have 3 people, probably 1/30 of the resources. But that's the difference of having 10 great companies in our portfolio versus not, and competing with 1,000 other angel investors. So I think that's something that stood out for us.
Okay, we got our first question from the audience. If you have another one, just raise your hand and we'll get the microphone to you. Okay, we get the second one over there. Carl, you're first.
Thank you. My name's Carl Hewitt. I'd like to drag a skeleton out of the closet.
Okay, skeletons.
Namely, the diversity skeleton. This is something I have personal experience with because I am chair of the board of a scientific society. And I know from personal experience how hard it is to attract diversity to our board of directors. People are busy. This is a hard sell. So my question is, for each one of the panel members, what kind of a diversity program do you have in your firm? And what do you do in terms of mentoring minorities inside your firm? And just to be fair, it seems best to start with Steve and ask about Price Waterhouse, and then the other you guys.
Nice softball question to lead off with. PwC has a huge diversity program, but I'm not really the focus of this thing, so I'm gonna punt quickly.
So I'll tell you, I think Silicon Valley, most of the people up here probably would describe themselves at some level as socially liberal but more fiscally conservative. That's sort of the Silicon Valley ethos. It's very libertarian with a lowercase l. True meritocracy. I would hire a woman, you pick whatever the thing is. If I found someone who's a rock star, I'd hire him. My LPs give me money to make money. So what I'm going to do is find the best people I can and the best partners I can.
Can we do direct answers? So I'll start. We have 4 full-time people. Half of them are women. All 3 investment partners are immigrants, all from different countries. We speak 15 languages among the 3 of us. We have 20 female founders. Our founders come from 23 different countries, and we invested in 7 countries with a team of only 3 from Palo Alto. And this is on our website. We have an infographic, so anybody can check it out on our website.
Okay, I think we got.
Just to follow up,
Why
are statistics among the partners of the VC firms so incredibly badly lopsided?
No one's going to touch it. Okay. Next question.
Okay, this one's more direct. My name is Nathan Shore, by the way. I wanted to go back to an original theme, which was what are the this is something the entrepreneurs in the audience, I'm sure, would appreciate. Back to what are exciting areas. One that seems exciting to me that I don't see too much about, what I was hoping to get your opinion on, is everyone knows about big data. That's huge. What about the opposite side, small data, individual data?
It's small.
Thanks. Sometimes it's called demand-side commerce or intent casting, but it's the whole idea of individuals using their personal data, managing it and controlling it. What do you think of that as an area?
I've spent the last couple of years working a lot on the so-called quantified self area. That, to me, has been pretty interesting. The first stronghold of that has been in health and wellness, but actually I think it applies to all things, whether it's your taste graph, your interest graph, your commerce graph, all those sorts of things. So I do believe that people opting in and wanting to broadcast their data out there into both public and private sort of pools for different purposes is very fascinating. And I think a lot of that is because we are all sort of the brand of ourselves, and we're all really good personal brand engineers in different ways now. And Facebook has taught the value of how much people love to build their aspirational self-identity.
Well,
What's interesting
Cloud's
to
the
me...
one that's really said
Yeah.
you could track that. Yes.
Yeah, aspirational identity and authentic identity are completely different. I never, I put it this way, I never tweet that I'm feeling depressed and I need to go to a therapist. I only tweet, table service, bitches, and, you know, so it's a failed tweet or failed status update is the one that gets no likes or no comments, right? And that's interesting because we're broadcasting lots of data, but where I'm trying to go with this, though, is with seamless, constant tracking that users opt into, can we capture more of the authentic behaviors as well? Because with that, you can tap into all sorts of things. Tricky balance, though, between sort of opt-in versus privacy and other dimensions.
Yeah, it is interesting. You should check out work done by Leroy Hood, who's a professor of biotechnology up at University of Washington, very well known, originally Caltech. He's looking at a lot of, and you've probably seen his stuff, Tim, and if you haven't, you should check it out. It was an Exconomy event last week, and I was blown away that some of the self-statistics, particularly for people with disease states, are actually going to, in some cases, start replacing or at least complementing clinical trials, even though they're obviously not placebo, controlled, randomized, And so it's something really interesting to look at. I've looked at it only briefly. There's a website called Treato.com. It's Israeli that's starting to look at this, and there are some data that are being teased out, which really have some incredible, could have some incredible impact, and really, I mean, he shared with us, could have more impact than the more traditional routes in terms of changing the way some of the healthcare system works and how people get treated for certain kinds of diseases and understand what's most effective. In some cases, that over-treatment that we see a lot of. So there's some interesting stuff you want to check out.
I think the important thing about doing it in the small is coming up with some unique business models, because you do it in the big, you get these flow streams. It's advertising, right? And we've got a couple of these small things, and I'm just not sure what the business models are at the end of the day. So the creativity is as much that as it is whatever the data is that's being out there. So I invite that.
Great. We got another question right here.
My question is actually pretty simple. What do you guys think about crowdfunding?
Crowdfunding. Is that good or bad?
It's been around forever.
Yeah.
It's been around forever. We used to call it friends, family, and fools. But
We're going to pass the hat tonight. We're going to pass the hat tonight. So we're going to do a little bit.
I guess I'll go.
Sure.
It's interesting. I'm sure there will be some interesting companies built around it. It has the feel, to me, a little bit of one of these fads that VCs and the media get really excited about and overfund a bunch of companies, and it's going to solve all the world's problems. And then there's going to be a glut of sort of crowdfunding companies. But I think it remains to be seen if there's a viable business model there. Would I like to have been in the angel round of Kickstarter? Sure, but I think at a certain point, you have to build a business there, and so I think it gets a lot of attention, but I think it's very early on, and I also think it's also a little bit dangerous, because what you then have are individuals who may be putting, it scares me, large amounts of their net worth or that into things that probably won't work. I mean, most of them probably won't work, and some will, and you hear about these great successes, and so I worry about people that don't know what they're getting into and end up getting hurt in the kind of the jubilation around crowdfunding right now.
I think it's a great thing, but if you peel one layer below that, first of all, there are good precedents. Lending Club, I think, is now $1 billion business. It's growing really fast. Not quite at bank scale, but if you look at some of the most successful projects on Kickstarter, like Pebble, it's actually people kind of putting an advance order for a good. So I think it's really great for those companies that I think for a while, among all the investors, hey, software skills, hardware is not as attractive. There's been a lot of minefields, and people don't want to back hardware. I mean, very originally, I was one of them, and what I've seen is hardware could be a great gateway to great software businesses. In fact, you almost have to do that for great differentiation and highlight great software. So that's something that I'm seeing. So I think it's great to see things like Kickstarter, and I think it's being successful, but we have to be careful not to generalize from that I think it's a great platform for all kinds of companies. I hope it works out, but when you look at it, majority of the companies that are most successful have a product where people are putting advanced orders and the money actually is corresponding to some small amount of like thousands of orders being placed. But it's a great platform for that, and I'm curious to see how it's going to expand.
You know, that or people who are looking for local support, that they want to keep a certain kind of store in their town or whatever. I think from your perspective, as I'm assuming an entrepreneur point of view, having been involved with a portion of the Jobs Act, and that was became a part of it later on in its life. I think that from where you sit, and given, particularly in Silicon Valley, the amount of capital that comes from even individuals who are experienced and can be of help to you, back to this idea, of value add. You'd probably rather have, I love my mom, but rather than my mom, who you really can't help you, you probably want to have, somebody who looks like, somebody here or other folks in the audience who have some experience, so that could be helpful for you to draw on. And that's why I think here, where you have a lot of angel capital available and other things, it's probably more traditional path that's going to be the first place you turn, rather than probably crowdfunding it, is my guess.
Right.
You might be finding it more unique business models and in different parts of the country.
But a key point of crowdfunding versus venture capital funding is the risk that the capital takes.
Yes.
If you lose it all, how do you feel? If you take it from your rich uncle, he'll probably cut you out of his will. If you take it from your neighbor, you shouldn't go home. But that's the risk capital, and that's a real key element of the Silicon Valley and the whole venture capital industry, is that we are willing to lose all our money because we will take the big chance on the big deal.
Or at least I think we're risking someone else's money.
Yeah,
I mean, we're investing other people's money.
That's a real key point.
When you go on Kickstarter, you or your mom was investing that person's money, and it can be kind of scary.
And that isn't the right place for retail investors.
It's very personal.
Think that the protections that got put into it, for those that are aware of it, that involved, limits for individuals that have, registered intermediaries now being, there was a lot of improvement and tightening up. It's still being reviewed by the SEC, and I think the SEC is going to make it even tighter. I think that's actually okay for the reasons that Bill brings up. It's a scary place for individuals to be. It's scary enough for them to think about being in public companies where there's a lot more information, a lot more liquidity. You can get in and you can get out. Usually at some price. In these you can't. So I think it's appropriate. And the SEC is probably going to, my expectation is make it pretty tight. So I wouldn't see that as a salvation necessarily for a lot of things, but I think it'll find its place like a lot of things do. I think there's a fad aspect to it, but I think it'll find its place.
We're moving into the lightning round, so we have quick questions, quick answers. Doug.
So I'm Doug Collum. Observation, which is in the 1980s, 1990s, it used to be kind of a badge of honor for CEOs and founders to want to go public. And my thesis is that these days that's no longer the case. So my question is, in your experience, is that true? And secondly, if it is true, does that influence your thinking in terms of the companies that you're prepared to invest in, or how you construct your business model, on the basis that CEOs these days are more interested in the quick exit and in an M&A as opposed to building a company autonomous enough and successful enough to be public?
I think when the bubble burst, I think Ray was saying earlier, talking about sentiment or emotion or what have you, when the bubble burst, anyone who was mid-level manager, CEO, what have you, of a company that was either just recently public or about to go public or that sort of thing, had like a life-changing, worst possible experience ever. Yeah. So that crop of people is permanently damaged. And for those people, they would sell in a heartbeat if they could. What we're seeing now, thankfully, 12 years on, is a new crop of people who were either too young in the organization, too early in their career, or weren't in Silicon Valley at all, that don't have that painful memory. And they're now saying, hey, this is cool, let's go public. And I think it's, we needed to get through that. We're not fully through that. There's still a lot of people that have that memory too near and dear to them. But I think there are a ton of people now that are looking at IPO as being something that's a great aspirational thing to do, and I think that we need that.
Lighting answer. Favorite quote on that is, and this is now public, when Mark Zuckerberg was faced with the first acquisition offer, his answer was, well, what would I do if I sold Facebook? I would go build Facebook again. I think Bill and I were very lucky that the same was true for Larry and Sergey. The interesting issue and the interesting spin here, though, is you do not know until you get to that point if that's true or not. A lot of entrepreneurs say, and they start with that intention of, yes, I will build a company that will be long-sustaining, will be very successful. And if anybody said here, like they have the crystal ball, they can see that, I would say don't believe them. But that's the interesting thing. It just, can you find those kind of people that are not driven by money? And I think in that same way, when you look at venture capitalists, are these people that are driven by, things like 3x returns, 10x returns, 100x returns? Or they're kind of driven by, we want to build great companies, we want to work with great founders, and that's what drives them, and financial returns are a consequence of making those choices.
I mean, we spend virtually no time talking to entrepreneurs about IPO. I mean, what we talk about when they're pitching is, who are you? What are you building? Who's on your team? How long have you known each other? And most of the CEOs I know, and let's look at Larry and Sergey, I don't think they look at the ones that I really like, I don't think they look at IPO as a badge of honor. Like, I think it was just something that they did, but it wasn't something that they talked about a lot early on, like we want to take Google public. But if you asked Larry and Sergey in 1998, the answer was, we want to organize all the world's information and make it universally accessible. And those are the kinds of entrepreneurs that we're talking to, not ones that are talking to us about IPO when they're pitching us so early on.
We call that the glimmer of greatness.
Yeah.
When you talk about it without the money piece of it. I just want to be great, because the money will follow.
Next question.
Yes. Can you comment on the role of intellectual property in your due diligence when you're looking at these companies?
The role of intellectual property. Yes, it's important for about that long, because unless you've got something really fundamentally that's protectable forever and big moat around it, someone can skin the cat differently, and you're going to have to move on. Now, healthcare, pharma, those places are different, but software, know-how is more powerful, I think, than IP.
Lighting answer, it is important, but the important fact to keep in mind, it takes about minimum $8 million to protect a patent. So it becomes an academic issue for really early startups.
Yeah.
So it's just something to keep in mind.
Yeah.
Next one over here.
Yes, my question is regarding sites. My name is Hassan Wardani. I'm from Australia, actually, but we're here to check out Silicon Valley. But the question is about sites like TripAdvisor and Yelp that have been having huge problems with reviews and ratings and things like that. How do you see that going forward, and what do you think are the solutions to the problems they're having? There's a site like Quora.com now who seems to have a lot of credibility. What do you think these sites need to do, or a site would need to do, to have that credibility in that kind of market or in that space?
So at Mayfield, we've been doing a lot of these sort of social Q&A and expert networks. One learning I have is that humans have a natural hysteresis of their biases. Think about it. You only have to be, you have to be extremely happy to write a positive review, but only slightly ticked off to write a negative review. And I'll give you a case in point. Like, think about doctor review sites. Doctors hate freaking consumer review sites because consumers review the dumbest things, like the magazines in their waiting room are old, and which has nothing to do with the efficacy of that. So what I'm looking for is actually, I love what Quora, Stack Overflow, GitHub have pioneered in certain verticals. Are there verticals you can super serve with social expert network dynamics that provide a lot of value there? And I would argue in some of these networks, recruiting the experts first are very important. I invest in a company called HealthTab, which is like Quora but for consumer health. And if you download their app, you can ask any health question, and more than 12,000 certified U.S. doctors will answer in real time for free. Why? Because of the validation, the likes, follows, agrees of other doctors is such a strong professional status signal, and much more so than what a consumer thinks of a doctor. So that's an example where if you built that up from consumer reviews, it'd probably be useless. So I find for generally public, just mass consumer reviews, N equals over 10,000, you start to get everything being 3.5 stars. You ever notice that? It's like everything's 5 stars or 1 star, 5 stars, 1 star. It's useless.
Okay, I think the next one was over here somewhere. Yes.
Ron Das. Going back to that M&A point brought a little bit earlier, I mean, if you want to summarize that whole trend in a macro level, I would say that the VCs are funding the R&D of the large corporations, especially in the hardware stage. Your reaction, your comments. Thanks.
Totally right. I mean, the pharmaceutical industry moved that way in the 80s big time fast. And they were driven, I think, mostly by Wall Street, those quarterly earnings. It's and then Congress created some tax incentives, right, to do it. So you put it out, you don't have to take the earnings hit, you let other people take the chance, let the venture capitalists take the chance, and you buy it later. And the arithmetic actually works. I think a lot of software companies are starting to do that now too, but clearly the medical places, it's the real deal.
Cisco did that to great effect in the late 90s.
John Chambers is famous for saying that.
Yeah. We're here on the side somewhere. Yes.
Hi, my name is Annie Chang. Twitter handle Annie G Chang. I just want to go back to kind of the first theme you talked about, Tim, about kind of the bridge and tunnel entrepreneur. How much of that is interrelated to the statistic that 40% of all U.S. venture capital is going into Silicon Valley? Having been a couple years removed from graduation, a lot of my friends and other, basically everybody wants to, being from the East Coast, wants to move to Silicon Valley to start the next Pinterest for cats or whatever it was. And
that's why we need immigration control.
Right. So
from New York.
Yeah.
Right.
I resent that. But anyway, and how much is it kind of the VC's job to kind of look for nascent industries in diversifying geographies and not just in Silicon Valley?
My quick answer on that is I think my job actually is kind of like armchair psychologist in many ways. I'm really trying to figure out, why do you want to start a company? I know it's been glamorized, but a lot of my entrepreneur friends, they tell me all startups, it's brutal work and everything sucks until it's good. It hits this point where things are suddenly magic, but until then, it all sucked and it was never fun. And so you got to ask, why are you doing it? Is it because all your friends are doing it and it's kind of hip to do? I mean, that's cool, but I really love those entrepreneurs who are doing it, like from what I said, either they love that space so much they would have built it anyway, even if it wasn't about making money and it just accidentally took off, or they cut their teeth having worked at Twitter or whatever first and then figured out the next thing they want to build.
Yeah,
I mean, why do you do what you do?
We don't spend a lot of time thinking. I mean, we've got offices in 4 or 5 different cities now and invested all over the U.S., and I'm sure many of us have, but we don't sit down and say, we need to invest in Detroit. We look for great founders, and take someone like Kevin Systrom, who used to sit next to me at Google. He started Instagram, and he didn't start that to make $1 billion. He started that to create a company that he was interested in and a product that he was really interested in, and they did a great job shepherding that product so that lots of people use it and whatnot. And the wrong, at least for us, the wrong question to ask when you're looking for a startup is, what city should we look in? It's sort of, where should we look for founders? In this case, it's someone who is sitting right next to us. But in some cases, it might be someone who's in Boston or Austin or Detroit. But we start with the people, not with the geography.
Yeah, and like Aydin, we spend a lot of time focusing on, first of all, sort of themes. So we follow that theme in that company wherever it is. In the U.S., our 2 best deals, one was in Provo, Utah, the other was Indianapolis, both multi-billion-dollar outcomes in the last couple of years. I think the question is, when you get out of Silicon Valley, the benefit is what Tim was referring to earlier, lamenting in Silicon Valley how competitive is to get engineers. It's actually better outside. So there's some real appeal from that point of view. Flip side is, are the people there really, do they have the mentality? Can you recruit enough good people? Can you fill out a team? Are they red meeting? We were worried that in the Midwest they'd be too nice. We got over that. They're fine. This is a company called Exact Target, went public a couple months ago. They figured it out. But that's the kind of thing. So we do diligence, slightly different things, but there's some aspects of getting out of Silicon Valley that's far better, more stable. The teams really work well together. So we really love, we go where the deals
competition.
Huh?
Yeah. Less venture competition.
Yeah, a lot venture, less people. I mean, because we're like, hey, we'll do 2-flight deals.
It's interesting. If you look
we'll get it. First of all, we'll get on a plane to begin with, and secondly, we'll do 2 flights.
If you look at the data, and again, I keep saying that, but VCs who are willing to invest outside of the geography that they're in, usually those companies are correlated with higher returns because it's worth the trip. Whereas if that company were local and you've got lots of options there, but it's got to be really special for me to get on a plane to Durham and invest in a company there. And the opposite is true of entrepreneurs, that if an entrepreneur who started a company and has been successful moves across the country to, let's say, from Boston to San Francisco, that person's odds of finding a positive exit revert back to the mean. Although they'll have a 30 to 40% better chance of a positive exit if they stayed where they were because that's where their network is. And so it's sort of opposite things working.
So in the 28 years that we've been investing hundreds of companies, the 5 or 6 biggest exits have all been deals that the partner who did the deal had to get on an airplane to fly to.
That's great.
And my biggest exit to date, I had to fly to Boston for, and I did it for 7 years every month and in between and that sort of thing.
Yeah.
So
Tel Aviv.
Yeah.
Yeah. Yeah, right.
Okay, next one right here.
Hi, Mark Weinstein with Scruples. That's with the group in the middle. So my question is privacy still dead? So the titans of our industry, the titans of Silicon Valley, declared this for several years. And now we're watching, the White House has a privacy bill of rights. We've watched Path come alive. We watched DuckDuckGo. We watched Reputation. And yet I still hear in the Valley, in the VC community, that privacy is dead. So I'm wondering, is privacy dead, or is there room? Is there really, something happening where there's demand for privacy, and that could be the next big thing?
So let me answer in an indirect way with 2 really cool anecdotes. I was talking to somebody from Palantir, and they told me that they were working with Australian intelligence. Australian intelligence gave them data. In 1 hour, they discovered a terrorist group that the Australian intelligence couldn't discover in 7 years. I looked at a 3D company today that's working with defense and intelligence, and they were showing us stuff that is used by special ops, where you can look at satellite imagery, but you can even go down to real street level, and you can start seeing details. So I think there is kind of the easy kind of business answer, and then there is the real answer. Whether we like it or not, I'm not really sure how much privacy there is. So it kind of depends on how you use your persona and how you control your data. Nobody's forcing you to be on Facebook or on Twitter, and yet you need to understand that once that data gets out there, it's very, very difficult to take it back. So it kind of becomes hey, how much do you want it to be? But on the other hand, there is also a lot of technologies there that, whether we like it or not, are sifting through stuff and have access to data.
Wondering about the consumer side. Is there consumer demand for privacy, or is that dead?
I think the next wave of the web is actually going to be what I call pseudonymous identity. If authentic identity is about Facebook and often your aspirational engineered identity, and anonymity is like those horrible comments on YouTube videos, makes me weep for humanity. But I think what's next is the rise of these vertical interest graphs, and each of us is a collection of different interests and affinities. Each of those may deserve its own pseudonymous identity with that, which not necessarily always tied to our authentic identity. Case in point, let's say you're dealing with a rare illness. It's not something you want to tweet about necessarily, your followers or share on Facebook, but you do want to connect with those dealing with it in an authentic way, right? But it is a pseudonymous, like a screen name, if you will. So I do think there's a lot of future in that. Plus, kids always hate what their parents are into. I can imagine the next generation being anti-Facebook and anti-sharing.
By the way, you see even with Facebook, there's been consumer pushback. Consumers ultimately win, and I think when it gets to people's lack of comfort zone, I think people are pushing back. They're not putting the really private stuff on. People push back on some of their policies. You're seeing more. I have to give my permission to, more obvious and more readable. So I think it'll find its right balance. And I agree with you. I don't think the right way, by the way, personally, I feel is not to have it come from Congress, but I think consumers are going to speak up and find the right. Because things won't
Okay, we
sell.
got our last question. Make it really good.
So I was watching The Daily Show. And Edward Conard was having a great debate, actually, with Jon Stewart. If you haven't seen it, it was just on this week. It was great. Cool. But they talked about tax policy, and they were having an argument over whether or not tax policy actually could crush innovation or actually help it. And you guys are the experts. So I was curious to hear from your standpoint, can tax policy help or hinder innovation either by impacting entrepreneurs or investors?
Well, really quickly, I don't think I've never met an entrepreneur, and I've met a lot of them, who even knew what tax policy was, much less watch TV, especially even Jon Stewart. So I don't think that matters so much. But I do think investors do pay a lot of attention to it, and it is a fact of economic life. The more you tax something, the less you get of it. So if you change a very nice economic system that's working quite beautifully and has for 50 years, if you impart some big negative forces to it, you're either going to get a big pullback or there's going to be rearrangement. The other thing, but I do have hope because we always sort of invent ways to get around these things. So no matter what Congress sort of comes up with,
Innovation.
I'm sure our lawyers in Silicon
You're
Valley.
setting
and
yourself
other
up for an
places-
audit, I think. Is
like I haven't
That was
been.
him.
No,
That
so
wasn't me.
anyway.
But there is a law of unintended consequences. Whatever great thing that Congress and their infinite wisdom designs for tax policy, you can bet it's not going to do entirely what they expect it to.
Right.
So I agree completely with what Ray said. I mean, I've had tons of conversations with entrepreneurs that have no idea about any of these tax things. Don't think about it. That's not what drives them. But when it gets, once they've made some money, then they're thinking about it. They're thinking about what they should do with it and all these sorts of things. And Congress can screw it up for sure.
And I really think for people in this room, broad strokes, getting rid of capital gains, long-term holding, now one could argue is 365 days long-term. Maybe it's a 3-year, maybe it's 5-year. It just, that would not be good broadly. It's risk capital, and you want people to have, for whatever business you're in, it's not just what we do, but real estate and other things. You want to encourage people to take long-term risks to build the kinds of things that pay off over time. Giving them some incentive to do so is a smart thing. I think you shut that off, you're going to have marginal impact, maybe a significant impact.
Okay, I want to thank our panel, thank our audience, and Avery Lyford's got some closing remarks.
Yeah, I'd like to thank the panelists for sharing their insights so freely, and Steve for leading a great conversation. I believe this is a great inspirational program. Look forward to seeing you all next week at the Oxford Union debate. Thanks again to Microsoft, TechCU, and Womble Carlisle. You've been an amazing audience. Thank you very much. Have a great evening.